Let's move on. Gosh, we're not out of time here, but let's move on to Knight Swift. They are a trucking company. I thought this would be good because maybe see something in the economy here. Their symbol is KNX, 6.2% short on the float, not too bad. PE ratio, not very good, 51.3. That's above the industry at 42.5. Price to sales, 1 versus 1.1. Price to book value, 1 versus 24. That's a positive. Price to cash flow, 9 versus 11.9. They do have a PEG ratio of 2.4 versus 22.5. Now, earnings over last year of 282% when the industry was down 21.9. We do see sales for Knight increase by, well, no, they were flat, no increase, but the industry was up 3.4. The analysts give it a 5-year earnings per share growth rate of 13.2 for Knight versus 6.9 for the industry. Now, they do pay a 1.6% dividend using 80% of the earnings to pay that out. Not that great, I will say. We do see on the balance sheet, current ratio 1.3, same as the industry. Debt to equity 0.5 versus 0.7. We do see a net profit margin 1.9 versus 3.2. Return on equity very bad, 2. We like to see it around 15. And then we have free cash flow. They actually have a negative cash flow of 62. I guess that's going to be $1 million versus the industry at 386 million positive. So not looking good. I do worry a little bit with the economy staying where it is, that trucking companies could have some problems. What do you see going forward, Chase?
Yeah, so current price here for Knight Swift Transportation, their ticker symbol KNX, is $45.12, 52-week range here. The low is $36.69 and the high $61.51. So a decent-sized pullback there from the high. Year to date, the stock has struggled down about 15%, obviously, when the broader-based market is up. Going forward, though, I mean, the valuation is still, I'm going to say, a little bit off. You go out to December 2026, estimated earnings per share here, $2.07. Gives you a target sell price of $34.36. So, I mean, it's still trading at 21 times those future earnings. And the interesting thing is the earnings growth. I mean, this year you're looking for earnings growth of 26%. Next year, 54%. And again, less analysts, but 2027, they're looking for 48% growth. That would push you down to a forward multiple of about 14 times. So who knows? Maybe if you get more of a pullback and, things still stabilize, you could look at buying this maybe at the beginning of next year. The valuations might come into a better play there.
And actually, the earnings going out to December 2026, they were down almost 15%. They were 90 days ago, 243, now at 207, as you said. And that's a big drop. So, again, we don't think we're going to recession. Yeah. A slowdown in the economy, but there's a slowing down of the growth of the economy, which can affect trucking companies.
I mean, this is a type of business you want to buy in a recession.
Yes.
Because the numbers will be low, and then you'll be coming out of that recession, and then that's where you could really find this on a great value at that time. So I think right now it's maybe too early to buy a business of this nature. And again, like I said it before, you might miss it, but I think being patient here with a company like Knight Swift could pay big dividends long term.